Two companies. Same year. One sells $383 billion of product. The other sells $242 billion. Sounds close, right? But one keeps 25 cents of every dollar, and the other keeps just under 3. I've read income statements for 50 years. Buffett's, Graham's, hundreds of annual reports most people never open. And here's what I learned the hard way. Most beginners stare at the top line revenue and stop there. That's the number that lies to you the most. The income statement is really just one story, told in 4 numbers. Learn those 4, and you can read any company in 90 seconds. Right, revenue is vanity. Profit is sanity. Revenue is the money coming in the door. Apple booked $383 billion in fiscal 2023. Huge. But revenue tells you how big a company is, not how good it is. Think of it like a salary. Someone earning $200,000 a year sounds rich. But if they spend $195,000, they're not. The same is true for companies. So we don't stop at the top. We follow the money down the page. Draw, revenue minus costs, what's left is what matters. And the very first cut is the one that reveals a company's real power. Below revenue sits the cost of making the product. Subtract it, and you get gross profit. Divide that by revenue, and you get the number I check first, gross margin. For Apple in fiscal 2023, gross margin was about 44%. For Costco, it was around 11%. Why the gap? It's not that Costco is a worse business. It's a different one. Costco makes its money on volume and membership fees, selling cheap. Apple charges a premium because people will pay it. That's pricing power. And high gross margins are the fingerprint of a moat. But a fat gross margin can still be wasted. Which brings us to the number that catches the frauds. Keep going down. Subtract the cost of running the business, research, salaries, marketing, and you get operating income. This is the profit from the actual business, before the noise. Apple's operating income in fiscal 2023 was about $114 billion. Then, below that, comes net income, the famous bottom line. Apple's was roughly $97 billion. Here's the trap. Net income includes one-time stuff, a lawsuit, a tax gain, selling a building. Operating income doesn't. Draw, operating income, repeatable, versus net income, can hide one-time noise. So when a company suddenly posts a giant profit, I ask one question. Did the business earn it, or did an accountant find it? Right, ask, is this profit repeatable? A great example, America Online in the late 90s booked profits that leaned on aggressive accounting. The bottom line looked strong. The real business didn't. 1 year of numbers is a snapshot. Wealth is built by understanding the movie. So I line up 3 years side by side and ask, are margins rising, flat, or quietly shrinking? Rising margins mean a company is gaining power over its customers and costs. Falling margins, even with rising revenue, are a warning that competition is biting. This is exactly how you catch a business in decline before the crowd does. The revenue headline stays cheerful, while the margin quietly tells the real story. Draw, revenue but margin warning sign. And remember, this is educational, not financial advice. Always do your own research. Past performance never guarantees the future. Here's the whole income statement in one sentence. Revenue tells you how big. Margins tell you how good. And the trend tells you where it's going. Right, big. Good. Going where? Most investors read the top line and feel informed. You now read the whole page and actually are. So here's my question for you. Pull up one company you're curious about, check its gross margin over the last 3 years. Rising or falling? Tell me in the comments. And if this made the numbers finally click, hit subscribe. Tomorrow, we're breaking down the one statement that reveals whether all this profit is even real, the cash flow statement.